Did you know that one of the most powerful tools in corporate America, a tool that quietly transfers trillions of dollars to shareholders, a tool that boosts CEO wealth overnight? This is the hidden story of stock buybacks. Before 1982, stock buybacks were treated as fraud. Today, they are standard business practice. To understand stock buybacks, we need to travel back almost a century to the Wall Street crash of 1929. During the Roaring '20s, companies discovered a clever trick. Buy your own stock, create fake demand, and push the price up. They didn't tell shareholders. They didn't disclose it publicly. It was a secret operation. When the truth came out, confidence evaporated. The stock market collapsed, banks failed, lives were destroyed. In response, President Franklin D. Roosevelt created the Securities Exchange Act of 1934. Its purpose was simple: stop market manipulation, especially companies secretly buying their own stock. For the next 50 years, stock buybacks were treated as a criminal act if used to influence price. Corporate America didn't complain. They knew what they were doing was manipulation. But by the 1970s, a new economic idea gained popularity. An idea that would flip decades of regulation upside down. Milton Friedman, a Nobel Prize-winning economist, argued that a corporation's only responsibility is to maximize shareholder value. This philosophy spread quickly among executives and politicians. It was simple, it was profitable, and it justified almost any method to increase stock prices. Then came the 1980s. An era of deregulation under President Ronald Reagan. Corporate America saw an opportunity. They needed buybacks to become legal again. And in 1982, they got what they wanted. The turning point wasn't a big headline. It wasn't a public debate. It wasn't even a major law. It was a 4-page SEC rule, Rule 10b-18. This rule said, if you repurchase your own stock within certain limits, we won't charge you with manipulation. Just like that, what was illegal for half a century became standard practice. There were limits, but they were loose, vague, and easy to exploit. Buybacks exploded almost immediately. Corporate executives had discovered the perfect tool: boost the stock price, increase CEO bonuses, and avoid investing in real growth. Here's the secret power of a buyback. When a company buys and retires its own shares, the total number of shares in circulation shrinks. this automatically increases the company's earnings per share, stock price, and perceived profitability, even if actual profits stay the same. Nothing real changes, except the illusion. For CEOs, this illusion is priceless. Over 80% of CEO compensation is tied to stock price, EPS growth, and shareholder returns. Between 2009 and 2019, the top 500 U.S. companies spent over $6 trillion on stock buybacks, more than they spent on research, development, factories, or employee wages. Economists call this financialization, when companies focus more on stock price engineering than real business growth. Instead of building the next breakthrough invention, companies started building stock charts. It's not that buybacks are inherently evil, it's that they became a shortcut that rewards short-term thinking over long-term value. Who benefits the most? The top 10% of Americans own over 90% of all stocks. So when buybacks push prices up, wealthy shareholders win, executives win, and workers lose. Economic inequality widens. Companies become fragile. Buybacks concentrate wealth at the top and hollow out the foundation beneath. History shows that economies built on financial tricks eventually face reality. In 1929, the illusion broke and the market collapsed. Today, many economists warn that excessive buybacks are creating the same artificial stability. High stock prices, low real growth, rising inequality, and a fragile system depending on belief rather than value. When belief fades, gravity returns, and markets fall. What do you think? Are stock buybacks a smart financial tool or a dangerous form of legalized manipulation? Tell us in the comments below. And if you'd like to dive deeper into the hidden mechanics of modern finance, make sure to like, subscribe, and turn on notifications. This is the Hidden Economics series. Thanks for watching.